Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Luke, thanks for taking the time out today to join me for this interview.
No problem.
We're just talking off air. This is probably the first longer form investor related interview you've done in quite a while. And I should give a shout out to Tony Hansen, who made the connection. Tony's one of those people that I believe doesn't listen to too many podcasts, but he said to me, if you can get Luke on the show, I'll listen. So he made the intro, and I'm guessing that he's quite a big fan of yours. So having done some research, I can certainly see what Tony likes, and just, I guess it's just part of your decision-making process, the way you set up the fund and kind of what you stand for. This conversation will probably be as much about investing as it will be about life and just thinking in general. But what I like to do, Luke, is I like to go back to the younger you and just kind of set the scene for our listeners. We're looking for, I guess, any common threads of entrepreneurship or business or just life lessons early on. So maybe if you can just start by telling us a little bit about yourself, the younger you, any mentors, and I guess how those may have shaped you and your study and your sporting career and things like that.
Yeah, cool. Thank you. I will try to remember some of those things. I mean, first of all, Tony, let me just say, Tony always speaks very highly of those around him, and I'm fortunate to know Tony. He speaks too kindly of me, but it's great to have made this intro and to be able to chat to you. So, yeah, I guess trying to maybe address your question, a younger me. I guess, yeah, like, don't know really why, but I've always kind of been fascinated by money. It kind of now, yeah, looking back at when I was younger, and I still do have these collections. You know, I used to collect coins and stamps and phone cards. But really, coins and stamps was the main thing when I was younger. Actually remember, just kind of like in our backyard, being able to, I had this kind of, there must have been, like, ages ago, there must have been something, our property must have been on some sort of marketplace or something, because there's, like, you could, like, literally dig in the ground, and if you dig long enough and deep enough, you'd kind of just dig up these old coins, like, you know, these kind of worthless pennies. But, you know, I was kind of really, there's particular year of penny that is really valuable. I think it's a 1931 off the top of my head, really, really valuable. I was just always trying to find one of these 1930 pennies, but I never did. But yeah, it was this idea of, I just had this interest in kind of trying to collect things and hold on to them, and, you know, I guess collect, and this idea of building up collections and storing value over time. And yeah, it's probably something that now only kind of has a bit more relevance to what I'm doing. But I guess it did kind of come out in different ways as I was growing up. You know, I remember with my mate, we'd he lived near a golf course, that the golf course bordered like some bushland. And so what we'd do, like on school holidays, we would just walk up and down like this thick bush, digging out all of these golf balls that have been, you know, hooked into the rough, and then we kind of clean them up and try to sell them back to the clubhouse. Lots of different things like that. I remember one of my stranger ones. I ordered the number plates shortly after you got the personalized number plates came out. I ordered the number plates USD because I thought, that's the biggest financial market in the world, the foreign exchange market, the greenbacks, the biggest currency. I thought for sure there'd be some person out there that's made some money on USD that would want to spend. I think I advertised, this was back when the Trading Post was around too, advertised it for 20 grand. And I hadn't spent, like it was nice too, because you could like just order the number plates. You didn't even have to pay for them or pick them up. They were just sitting at the registry for me. And I could then go and advertise to sell the number plates, even though I hadn't paid anything for them. And I got one call. Unfortunately, I didn't kind of consummate the sale. I'm a terrible salesman. And unfortunately, I didn't actually get to sell them. So I just obviously surrendered them. Lots of different kind of things like that, I guess, off the top of my head, that I've kind of done when I was younger, but then obviously getting older and, going through school and university, stocks kind of became interesting to me. And that's kind of what prompted me to study finance and economics at uni. And I guess from there, it kind of gave me something a little bit more formal from an education sense to apply this strange interest I had towards, like trying to generate kind of wealth over time.
Was there anyone in your family or friendship group that was a business person or influenced you in any way?
Well, my father was definitely a businessman, but he was a sales person. So I found, and he would come home and he'd just talk about like his job, like incessantly, which kind of drove me mad. But it definitely did open up this world of like, like I wonder what all these kind of deals are about. But it probably wasn't, to be honest, it was probably more my background in sport that was a greater mentor, so to speak, to it. So like kind of this idea of accruing value was rightly or wrongly just there, independent of what my dad was saying. And it wasn't like, and I found like probably now looking back, it was like, so I used to swim competitively. And it was through that process that I think a lot of things were able to be formed up in a way that gave me structure going forward. So like with swimming, I think it's a wonderful sport because, and it speaks to investing a lot, I feel, because it's something where you need to do a lot of work early on. You need to commit to it, and then do a lot of work to build up your kind of strength, skills, ability, and then you kind of maybe get one shot at delivering on it. And whether you deliver the performance or not kind of comes down to the individual, rather, and it's very objective whether you deliver the performance or not. Like it's like completely time-based, quantitative. There's no subjectivity around a judge's score or anything. It's really about, have you done the work and can you get up and back faster than anyone else? So it comes down to whether you're prepared to do the work and how you execute your race. And I really like that simplicity, that objectivity of swimming, and then what's required of the individual to get the goal that they want at the end. It's you have to have a framework, you have to follow the framework, and I feel a lot of those aspects are consistent with investing.
And now that you say it, I think so too. We've had some people that have played professional sport on the show before, So were you swimming professionally before you studied at uni?
Yeah, so swimming's one of those kind of sports you start fairly young, and you would typically have to commit to it fairly young to be able to compete at the high level. Because the age of kind of the best age for a swimmer is between probably 18 and 25. So you kind of have to had to have done years and years of work before you hit, kind of 18. So yeah, I mean, I guess professionally, there's probably not many people that swim professionally because there's not much money in the sport. So I was swimming at an elite level from probably 19, I think, my latter part of uni. And yeah, and then swimming through to when I was about 25, 26.
Yeah, right. And so you kind of
Sorry, I was just going to say, yeah. So there was a period there where I was swimming at that level. I was studying at uni, and I was also working. So that was probably for about 1 year.
Yeah,
So,
right. Because I was going to say, because it sounds like you had to do them both, like investing and learning and studying, while also swimming and getting better in that respect. So maybe you're being a bit modest, but I feel like you were quite good at swimming too.
well, I mean, it's relative, right? I guess I was good compared to the general public, but well, it's quite humorous, and it's a story that's at my expense. But when my wife lived, when we made our first Australian junior team, that was in 2002 at the Oceania Championships, and I swam quite well at the meet. Broke some records and won some races, and ended up getting swimmer of the meet. And she swam okay. I think she got kind of third in the 100 freestyle. And she kind of caught my attention too at the time, and which no doubt helped that I was swimmer of the meet. Well, the fact that I didn't catch her attention was disappointing, and I thought the fact that I got swimmer of the meet might help, but it didn't. It took a little bit more work on my behalf, but it was probably, I think, 18 months later. After that meet, she broke the world record in the 100 meters freestyle. So it was this kind of experience where I was maybe, kind of doing quite well. And then 18 months later, she was just like on a completely different plane. And, that was interesting. That was challenging, to be honest, because we were both kind of pursuing our swimming careers, and all of a sudden she was like not just the best in the world, the best that the world had ever seen. And yeah, it was kind of tough because now she was doing things that I dreamt of, and you kind of have to go back into this role of not only trying to pursue your own swimming career and getting the results that you want to get, but you also kind of then have to play this real supporting role to, because then, like, she was off to the Athens Olympics at that point in time. I didn't make the Olympic team, which was, that's tough. But then you have to go straight into the role of like supporting her and making sure that, together, that we can try to get the best result at the Olympics, which is a huge opportunity. So it was tough in a way to kind of go through that whole process of trying to progress your swimming, and then also being very much kind of in a supporting role. So it was one of those things. It's really great kind of learning that. as a younger person, it gives you a lot of humility, being able to reflect on your own actions, understanding, you know, why you do things, or, you know, making sure if you do something that's probably not the most conducive to, you know, functional outcomes, to try to reflect on that as early as possible, so you don't just end up with dysfunctional patterns of behavior that, you know, result in you not doing what you could otherwise do.
So did you see that in other swimmers?
Did I see that behavior in other swimmers?
Yeah.
Probably. Well, I don't know. I saw it in myself, but I didn't recognize it in myself at the time.
Right.
So
what do you mean by dysfunctional behaviors?
Well, I mean, it can be, you know, you just essentially in that context, it's focusing on the wrong thing. Like it's being, you know, feeling down, deflated, dejected, jaded, whatever it might be about someone doing something that you want to do, focusing on, essentially focusing on everything that isn't within your ability to control. It's then, focusing on the outcomes instead of the process. Again, so as an athlete, as a swimmer in particular, the best that you can do to either achieve your goal, whether that's ultimately, you know, to make a team, to win a race or whatever it might be, the best thing you can do is to deliver the best race that you're capable of doing on that day. And to do that, you need to focus on the things that you can focus on, which is very simple. And it's actually, it's a bit hard to do, but it requires, you know, not like you kind of like in the swimming sense, you're standing next to the people that are literally you're racing against, right? So, and they're, I don't know, 1.5 meters away from you either side. So in that context, you need to keep all of your attention between your own lane lines and none of it directed to the person next to you. Even as the race, like before the race, as the race is about to be swum, as the race is swum. And, you know, people have different race strategies. Some people, you know, kind of sprinters, they might go out hard and then have less capability in the second half of the race. And so there's lots of opportunities for you to become distracted. And that's definitely one of them. So, and it's kind of hard to, I mean, I think it takes a lot of practice to do consistently and to do well. And again, kind of tying it back to investing, it's one of those things. I think, you know, if you can go into investing with an absolute goal and objective of what you want to achieve and not worrying about what other people say or do, the way other people invest, where other people invest, what your benchmark is, like, you know, it's one of those things of like a relative benchmark. All of those things are like you kind of your attention being drawn from your lane lines into the ones next to you and to these objectives that aren't relevant to you actually delivering on what your goal is. So, I think it's you know, and as the meets kind of get bigger, this is now returning back to the sport, you know, it becomes harder and harder to do. So it's what determines typically why someone can win successfully and why someone might not quite be there or not quite get that result. And as the meets get bigger, as the attention grows more intense, it does get harder. And that's definitely one of the things that Liv and I learnt from 2004 at the Athens Olympics. You know, she went into the Olympics as the world record holder in the women's 100 meters freestyle, which is probably the highest profile swimming event for a female. And and yeah, her attention leading up to the meet, like this was her first Olympic Games. Her attention leading up to the meet kind of drifted from what she needed to do and more towards taking on the expectations of, you know, the public, people close to her. It's like, well, you're the world record holder, so you should win, right? And it's a very different beast. The Olympic Games. I mean, she broke the world record in the semi-finals of the Olympic trials in Sydney when, you know, basically, or relatively speaking, no one was watching. And then, yeah, to go into the Olympic Games as the world record holder, you know, as a kind of, yeah, as a first time Olympian, was a different experience. So, and it was tough. She ended up just missing the final. She placed ninth by 8/100ths of a second. And yeah, to make it more challenging, her Australian teammate Jodie Henry ended up winning and breaking the world record in the final. So yeah, it was, you know, it's one of those things that's you kind of learn a lot from sport.
It sounds like there's so many profound lessons that I'm kind of piecing together that have shaped how you invest, if we bring it back across to that.
Yeah.
So you managed to do some undergraduate study in investing in finance. When did you decide that finance or investing was where you wanted to head, as opposed to focusing more intently on swimming? Or was it kind of the best of both worlds, where you could still do your training and move across and learn how to invest better? We'll just get the technical details down.
Yeah. Well, you know, again, so swimming has you kind of, it's not a sport like golf that you can just keep playing and playing. So you're kind of always making sure that you're pursuing some career objective. And like I said, like the idea of creating wealth was something I'd always been really intrigued by. And so it was always there. And I was always progressing at, I guess, that in some way, shape or form, like university studies, through my swimming career. And I was really fortunate too, really fortunate, where kind of as my swimming was kind of reducing down, it was just at a really nice natural time that I was looking to kind of grow into an investing career, and yeah, like there was a nice crossover. Like I was finishing my university studies and also starting to invest funds personally for us, and in the stock market, and also swimming. And then kind of the swimming was petering out, and then I was like, well, you know, I kind of like want to get a job, and I was investing, but I didn't really know what I was doing while I was investing in the stock market. I was probably more like a technical investor. So I was, kind of reading books about technical analysis and trying to come up with my own stuff, and never really felt like I knew what I was doing because I didn't know what I was doing. So I thought, oh, well, I'll go, you know, be a stockbroker because they know what they're doing. And so, yeah, I kind of then joined Wilson HTM in 2007. And like I said, that was like right as my university was finishing and right toward the end of my swimming. And it was great because, I mean, they were really accommodating. It was a really strong market at the time. It was a really strong bull market at the end of a bull market.
That was just in the lead up to the GFC, right?
Yep. So yeah, so they gave me a bit more flexibility to be able to turn up a bit later. And I think I don't know if they've really noticed when I was nodding off at the back of some presentations. We had like, you know, some small junior mining explorer come in and want to raise some money for some wells or holes that they want to drill somewhere, which I found quite boring. But it was really good to get that exposure. But I think probably a couple of weeks in, yeah, I realized I wasn't going. I was definitely not a broker. I wasn't interested in broking at all. I was just far more interested in understanding what these businesses were doing.
So rather than the selling, more so focused on the analysis of the business.
Yeah. I think I was there for 18 months, and I think I executed 2 trades. So I was really bad.
I was going to say you wouldn't have been the best broker.
No. Like I remember at the time, like the brokers around me were like, they'd complain if they ever had a donut day, like, you know, a day that they did nothing. Whereas like, you know, if there was a day that I did something, well, you know, that was probably of note. So, but I was really fortunate, like during my time there, I befriended the senior analyst, and I was able to spend a few weeks with him, understanding what he does, how he looks at companies, how he forms his opinion, how he takes that opinion and gives it to the brokers, and then obviously the brokers go and sell it. So, and I found that really far more interesting. But you know, I guess I had to return to the desk, so I was employed as a broker. So yeah, that was one thing I couldn't get away from.
So this is obviously the height of the GFC. You've got this job for 18 months. From what I can tell, that kind of ended in the GFC. Like
Yeah.
Just as things were getting pretty hairy.
Really bad. Yeah. Yeah. So it was, there was a few things happening there. So with the analyst that I'd probably be fair to say was my mentor, one of the days he used to kind of walk around the floor like a you know, wily old fox or something. One of the days he just walked past and dropped a book on my desk, and it was Lessons for Corporate America, the essays of Warren Buffett. And I'd read like tons about investing, and I was trying to like find my own strategy. And that, likewise, like, as I mentioned, that's why I became a stockbroker. But I never really felt like I knew what I was doing. And I had a book of Buffett's at home, but I never read it because I just thought he was so boring. It's just, you know, obviously you buy things that are, you know, required or desired by consumers, and then you hold on to them for as long as possible. I was like, oh, like, you know, yawn. So I never actually read it, but when the analyst dropped this book on my desk, I like opened it up and I literally read the first paragraph, and I felt like, you know, just the world made sense. Felt like I was finally reading words of someone that knew what they were talking about. And then I looked back at the screen, and instead of just seeing lots of kind of meaningless, arbitrary numbers, they all meant something now, which was really nice. And yeah, so, you know, there was that, and then I went into the process of like being able to work with him for a period of time and research companies. And I remember there was one company we were looking at, and this was now probably mid 2008, and the GFC was really starting to kind of shake things up. And he said, well, we finished the work. He said, I value this company at X dollars. And I was like, wow, that's crazy. You would value it at 2X or 3X or something, way more than that. He said, well, I might. Well, he said, that's probably very, very much the case, but I need to frame my research around two things. One, where I think the stock's going to be in 12 months, and two, what the market will be prepared to pay in this environment. And I heard those two things. I was like, what, you're kidding me? Like, seriously? Like, that's how you actually work? Because like 12 months is like way too short to understand what the merits of a business, or what the merits of a business's operations, right? Like, it's far too short. You need a much longer period of time to understand if the company's actually providing value and being able to capture some of that value themselves. And then as well, like, looking at something in light of what the market is prepared to pay, I was like, well, like, you're forcing yourself to pay high valuations in good markets and low valuations in the market that we were in at the time. And I was like, if that's what you're doing, you're kind of trapping yourself into always generating effectively market returns. And I heard that, I was like, I love this area, but if that's the way that the industry works, I don't want any part of it. And the flip side of that is, if that's the way the industry works, then there's this huge opportunity to do something that is decoupled from that mindset and mentality. So yeah, I kind of walked. That was now, mid 2008. I started thinking how I could leave broking and set up a vehicle in which I could basically write the rules around what's important, and what's going to shape what's important for us in terms of determining where we're going to allocate capital and how we can hold on to that capital over a long period of time, to kind of to give us this kind of space from the industry, to decouple from this kind of inertia, the way that the industry works. And I knew to truly get that independence, I had to do it truly independently. So I wasn't trying to align with any sort of institution. I hadn't spoken to anyone at that point in time that suggested, people around me had a similar point of view. So yeah, I kind of just went and worked out how to try to set up the structure myself, which took a full year, around what I thought were the three core principles to remaining independent, being able to deliver value, identify opportunities without this relative lens of looking at the world, which I thought would get us to the most important thing at the end, which is our investment objective, an attractive absolute after fee rate of return.
What were those three principles?
Patient, like taking a patient approach. So, wanting to identify opportunities that we can leave capital in for a long period of time. So patience, performance, and alignment were the three principles, and the performance being based off an absolute benchmark rather than a relative benchmark. Again, getting us out of this mindset of feeling like we have to worry about what our competitors are doing. If, for instance, our benchmark is 10%, so it's always been 10%. So I know, like in 2010 when we started, I knew in 2010 we had to deliver more than 10%. 2011 was more than 10%. 2020 it would still be 10%. 2025 it would still be 10%, and which then helps the first principle of patience. So you can look at an investment opportunity and just through an absolute perspective and think, well, it doesn't really matter what I think the market's going to do over the next 12 months or 24 months. Are we kind of in a low interest rate environment? It's going to mean stocks do really well or anything like that. It's just taking this, well, we just want to deliver more than 10%. So I know that's what we want to do this year, and that's what we want to do in 10 years' time. So if I think this company will be able to support that objective at the price that it's prevailing at this point in time, based off what we know about its competitive position and everything that it does, then let's buy it. Do you know what I mean? Rather than worrying about what John across the road is doing or what the index is going to do. So it's really kind of helps that patient approach. And then the last one, alignment. That's just the foundation, I think, to any financial service, or needs to be, whereby if you're acting on behalf of someone else, you need to make sure that you're exposed to not just the upside, but the downside of any of your decisions. And that was obviously a thing that's massively missing with broking. It's a transactional service, so you obviously you don't want your clients to get so upset about your investing recommendations that they leave you, but there's actually not really anything with broking that rewards the broker for delivering their client a good investment, and likewise there's nothing that really penalizes the broker if they haven't done a great job. And kind of at the time too, in 2008, when I looked at the funds management industry, it was quite reflective of broking, where there was so many funds that were set up seemingly prime objective to earn a management fee. So they know all they have to do is get some of that superannuation assets into their fund, and each day they get out of bed, they know they're going to get paid, and if they deliver performance, then great, but if they don't, well, they're still going to get paid. So I kind of looked at all that, I was like, well, that's like really uninspiring, and it's completely decoupled from this kind of mentality of an athlete, which I really aspire to. I really love. The athlete only progresses when they deliver the performance, which is just so nice. So yeah, kind of wanting to bring that into the investing. So it was just trying to set up a structure with those three core principles: patience, performance, alignment.
I've heard you say before that having that hard or absolute benchmark promotes original thinking, and I feel like that's one of the essential advantages of being a private investor, is that you don't have to benchmark yourself if you don't want to. So you can make the best choice for whatever it is that you're aiming to do. Just on that alignment, then, with the fees, how did you set that up? Are you able to say how you set that up?
The alignment, yeah.
Like, was it a management fee or a performance fee, or like what did you think worked best at the time?
Yeah. I mean, just on your earlier comment about the nice aspect of not being able to, not having to benchmark yourself. I mean, that's good, but for me, it's important that you can still measure how
Absolutely.
you're performing. So you don't want to then just go, oh, well, it doesn't matter. So you still need something to measure yourself against. So that's just kind of one of the things I'd say there. And with regards to the fee structure, so I think it was the first 4 or possibly 5 years, the only fee we had was a performance fee. And the performance fee was only payable, obviously, when the return was above 10% in a year. And that was because, again, like I wanted to clearly demonstrate to our unit holders that, I was managing this fund for performance. It wasn't to generate kind of just a annuity stream for myself. I only wanted to get paid when I had delivered performance. It was, that was one of the reasons why it was set at 10%. The benchmark was set at 10%, because that was roughly what the All Ordinaries had returned for the past 25 years, including dividends at the time. Again, I only wanted to get paid when I delivered something over and above a kind of market return. And that was, that was in place for a few years, but it was to the point where I think Liv and I were starting to try to have a family, and all of our investments, like as much as we could get our hands on, was in the fund. Needed to be, because the fund started with $80,000 from 5 people, I think it was, and so it was small, and it was tough too, because I kind of obviously wasn't earning any income anyway, because there was no management fee, and any performance fee that I was earning, we were reinvesting the whole amount back in the fund, including GST. So actually, when a performance fee was generated at the end of the year, it was this massive cash hole for us. Like, we'd have to pay 10% to the ATO, and then we have to fund the full tax liability to the ATO. So, but I just, I was spending all my time trying to find these companies. That was the whole point of the fund, is that I actually am investing myself into these companies, using other people's money, as kind of strange as that sounds. And so it was kind of tough, and we were looking to start a family. And so we're at this point where I was like, well, I kind of need to introduce something to help keep the lights on. Because as well, Lib's income, like, this was now 2014, like, she retired from Sumi in 2012, and it was a completely different market now for kind of corporate engagements, and it was tough. And we actually ended up selling our house in 2013. And we had this conversation. I had this conversation with Liv in 2013. It's like, because 2013, that was our best year. I think we delivered 50% before performance fee. And so, we had a good performance fee that year, and it ended up being this massive cash outflow for us. And I was like, I'm not selling a single unit in this fund. I'm sorry, we got to sell the house. And so we decided we'd sell the house, and we did. It sold at auction, and anyway, it was a bit of a strange circumstance. It was unconditional. The purchaser paid a deposit anyway. They had to pull out, and so we were left with this situation of now again needing income, and neither of us were earning any. And so I introduced a management fee. There's a long way to kind of get to your point. Introduce this management fee, but the way that I kind of rationalized to get back to where we were, of only having a performance fee, was to implement this, what I termed as a management fee rebate. So anytime a performance fee is, or over the years, a management fee is paid, then that amount is rebated back against any performance fee that's accrued, right? So at the end of the year, if a performance fee has been earned, then the management fee has simply acted as an advance on that performance fee to help keep the lights on throughout the year. And investors don't actually pay any more. And if a performance fee isn't earned, then the management fee is carried over into future years.
So one of the things that we didn't really talk too much about, Luke, was something that you and I spoke about a month ago now. That experience during the GFC, which resulted in you selling the houses and then putting the money, and this was pre Blue Stamp, I believe. Yeah, Can you just relive that experience? And I guess how you convinced Lib to let you do it.
Yeah, yeah. Yeah, so that was at a time when I was kind of really digging into everything Buffett, and spending time with the analysts and going, wow, this is really cool. We're investing in businesses. And yeah, the GFC was really kind of rattling the markets and making those businesses cheaper and cheaper. And by the like each day you'd turn up, they'd be a bit cheaper, and it kind of just went on and on and on and on, which was, you'd see these kind of these businesses that you're looking at and probably admired just becoming cheaper and cheaper. And I was kind of we were investing all of our savings at that point in time, and it just kind of kept getting worse, which was just more kind of exciting to me. And we had an investment property at the time, a little unit, and I said to Limbo, I was like, I think we should sell this because there's far more attractive things happening in the stock market. So we did, and that was great. That was fine. But I invested those funds, I think, in about a week. And it just kept falling again and again. And to the point where I was like, this is just now, like, I don't even know what people are doing. Because like you'd have these businesses that, their operations would be probably fairly resilient, and, might have had zero debt, might have had, meaningful cash, but still, falling and falling. So yeah, we kind of had the conversation with Lib to say, well, how about we kind of sell our home as well. She's super supportive. I think that's one of the really, and that's like Blue Stamp is built off everything that Lib's done. I wholeheartedly know that. It's only there because of Lib supporting it. No, I mean, through all the years, and this kind of preceded that, when she kind of agreed, and we sold the house, and I invested those funds probably in about a month, and it was probably after that I was like, well, that's it. Like for us, like I've invested all our money, like how do I keep doing this, because the market keeps falling, so I need more funds. And I wasn't interested in broking. And again, it was at the same time as, the Buffett and with the analysts. And I was like, I'm reflecting on other managed funds out there. And I was like, I think there's an opportunity to create a fund that's decoupled from all of this, where I can be remunerated when I've generated performance, and then I'm incentivized to work kind of hard, or as hard as I absolutely can, to generate performance, because then that's how I get paid, and I can use the capital of other people, which is like essentially kind of, infinite, to invest myself into these businesses that I was spending all of my time trying to identify. So I was like, well, that's definitely a better course of action to take. And if this is how the market thinks about looking at companies, then what a great opportunity this was. So in a really kind of selfish way, I set up the fund to use other people's money as a way to leverage my own wealth creation into these businesses that I was trying to own myself. So using other people's money to buy these businesses that I actually just wanted to own myself. So that was kind of roughly how it all took shape.
I heard you say in the past that you effectively sold 2 houses and you got 2 businesses or 2 shares in return.
Yeah. Yeah. So that's probably a bit of a dent in my personality where I'm maybe a bit too intense. But I only want to invest in companies that I feel like I really know and I'm comfortable with, and I understand their industry, I understand their competitive position, and all of the ins and outs. And so that's to the exclusion of lots and lots of other opportunities. And um, yeah, I mean, it was interesting times when the whole market was falling, but I was just pouring our capital into two stocks. Um, and I don't, that just seemed natural to me. That just seemed like the way that I wanted to invest. Rightly or wrongly. It's obviously very concentrated. We had all of our capital in two stocks during the GFC, but I was very confident that we were getting far more than what we were handing over, and that our capital was definitely safe. And it was also a decision that I felt like we were making an investment in capitalism at the time. Like such were the circumstances.
Mm.
I was like, you know what? Like, if capitalism prevails out the other side of this, then these are going to be great businesses. We're going to do well from our investments in these businesses. And if capitalism doesn't prevail, then obviously, our investments aren't going to be so good, but there's going to be far bigger problems out there than us not having a house to live in. So, it was really an investment kind of call on capitalism, which again sounds very dramatic in light of the current circumstances that we're in right now, being what seem to be far more economically worse, but the market's indicating something different.
There's this thread that it's pretty obvious. Whether you probably knew it or not, when you were pursuing sport, I guess you were so focused on something, and sometimes that can come at the exclusion of other things, right? So you kind of just set your mind to something, you focused on it. And the same thing with starting the fund, and even that investing experience is you found something, you focused on it, and you didn't look outside your lane. In terms of swimming, you didn't look outside your lane, and you focused intently on what you wanted to achieve. Why don't we shift now to a bit more of kind of like the process that you follow and how you think about investing, and just from a higher level. One of the quotes is on your website. It's, whilst being influenced by value investing philosophies, Blue Stamp follows a proprietary approach focused on investing in businesses that are displaying growth. Can you flesh that out a bit? Like, what do you mean by proprietary, but then also why the growth focus? Like, is it simple as 10% hurdle or something else?
Thanks for pointing that out. That's probably would have written that quite a few years ago. I don't know if I'd write it the same way now, but proprietary sounds a bit strange. I guess what I'm trying to say there. So just to rehash your question. So it's how do we look at growth and what makes it proprietary?
Yeah. So what? And this is the thing, right? We're just talking about not swimming in someone else's lane and not focusing on your peer, focusing on what you're trying to do. So maybe the right way to frame it is just literally, what are you trying to do? And then how do you go about doing that? You're not just invested in Australia, you're invested overseas. One of the other quotes that you had was, the most effective mechanism to protect the value of our capital is to invest in businesses that are displaying growth. This growth will not only help defend against the many moving factors that go into any company's valuation, but it will also provide the opportunity for satisfactory returns to be achieved. I feel like I just answered your question. I don't think so.
No, I think, yeah, and that is it really. It's kind of growth is important, and it's something I kind of didn't appreciate earlier on in my investing career. I was looking very much more for cheap stocks, kind of cigar butt type things, but not. We did some arbitrage transactions early on, but still, with the lens of wanting to allocate money for long periods of time. So I was still looking at kind of cheap companies, particularly coming out of the GFC, where most things were cheap. And that really informed a lot of my thinking early on in kind of blue stamp years. Is just trying to find cheap companies, low PE multiples, all those types of things. But I kind of reflected that, or realized that most of those companies, they weren't growing, right? So you might get some one-time uplift when the market realizes maybe they've just priced that stream of earnings too low. But it's, the company's not really going to make you wealthy over a long period of time. You have to then find something else to recycle that capital into, which is hard. Like that. So if you're kind of looking for those like one-time lifts, uplifts, then there's a lot more work in that. And it's just harder to do, and it's harder to do as the fund gets bigger. Whereas if you can find a company that through whatever it does is growing, and it has quite a runway ahead of it to keep growing, well, that's going to make, this is kind of my thought process, that's going to make my job so much easier, because I only have to find one of them once. And then I can just leave the funds with that company, provided, at that point in time, we're kind of happy to invest at the price. But parking that, it's like that price consideration. It's like, wow, that's going to make my job so much more manageable. Not only like, will it make the number of new ideas I have to come up with each year way less, it also means that I could probably manage a lot more money than what we were at that point in time. So there was kind of that aspect to it. That's why I think kind of a reason why I think growth is important. But as well, for a company that's not growing their earnings, or their earnings are in decline, it's actually quite risky, I think, in a way, if you're investing over a long period of time in that company, because you have to be a lot more confident, probably a lot more precise with its valuation to get an appropriate rate of return on that opportunity. Because if you get a little bit wrong, there's no buffer. You can't wait another year for earnings to catch up, at the expense of, your average annual rate of return. You can't, like, things are just getting harder and harder and worse, like for a company in decline. So that introduces a lot of risk. That's not even to mention the whole aspect of, getting scalable returns, needing to deploy more capital, not trying to reduce transaction costs, friction costs. So if you're part of invested in this company, in this boat that is sitting on a tide that's going up, then that's just, all else being equal, just going to make your job easier. And valuation is always important, but there is just more buffer. There's more of a margin of safety in a company that's growing than in a company that's not growing. If more sins can be hidden, it's as terrible as that sounds, in a company that's growing their earnings. And there's more differentiation that you can add. So the market taking a 12-month perspective, maybe 18 months, very, very hard for someone with that mindset to look at a company that has really long-term structural growth opportunities ahead of it in, meaningfully large markets, to put a valuation on a company that justifies that opportunity in the outer years, in year 3, 4, 5, 10, 15. Almost impossible. So if you have this ability as an investor to think long-term like that, by virtue of consistency with those people that have given you the money, so as in, it's all well and good if I were to think like that, but if my investors don't bring that same mentality to the table, if they want the 12-month return, if you don't get it, then they're pulling their funds, well, it's going to come to naught, right? But if you as an investor, as a manager, have been able to cultivate investors that have a consistent mindset to your own, and your mindset is longer term, well then, man, you're going to go into this knife fight with a machine gun, and you can do some things that other people just don't have the capacity to do, either because it's not reflected by their investors or because their benchmark is something that chops their horizon down into a shorter period of time. So yeah, if you have that capability, you can look at these growth companies and you can invest for year 5, for year 10, confident that you're going to get the value which you think, and it might be a little bit, different either side of it. But roughly, you're right. Like, better to be roughly right than precisely wrong. That's kind of the general idea. Better to be roughly right about a growing company than a precisely wrong idea about a company in decline. Again, we're not trying to pin the tail on the donkey. We're just trying to say, that's a donkey and that's a stallion. Let's go and invest in that company. Again, at a price we feel like we will be able to generate a decent rate of return on. So, I mean, that's kind of roughly the idea around why we invest in companies that are growing. Yeah.
How many positions do you typically hold? So not just at any point in time, but is there any hard number you think is manageable, or is it more just opportunity costs and weighing it that way?
Yeah, it's not something that I bring and say we're going to hold this number. There is no kind of defined parameters around that, but you probably could imagine it's concentrated. So I think the most that we've ever held is 10 over the years. And what would we roughly hold? I think probably on average 7, but that's concentrated into the top few, which again is just consistent with the way that I seem to be wanting to invest. It's not a conscious decision to say I want to invest in this few number stocks. I would love to invest in 20, 30, 40 if I felt like we were going to get an equivalent return. But there's no way that I could cover that many number of stocks to the level that I would feel comfortable with. So it's just been a bit of a product of, that kind of bit of intense focus on things that's naturally caused us to have a concentrated portfolio.
So then I imagine, to your earlier point, that you don't turn over the positions all that often. I imagine you're measuring things in multiple years, not months, like some investors do, regrettably.
Yeah.
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 One thing, I went back through your letters, which I think for anyone that reads them from our listener base, I think they'll probably hold them in, or at least I do. I can't give away my top three, Luke, but I can give away my top five in Australia, and you're definitely in it. And I went back and I read 2011, and obviously this was the time when there was a lot of the European debt crisis and all that was in full effect. And I just wanted to pick your brain a bit on macroeconomic thinking. And one of the things you say, even with all of this in mind, I'm incredibly bullish on equities. Why? Even if the US, Europe, and Japan default and China makes a mess of their economy, there will still be 6.9 billion odd people living on the planet who still need to consume goods and services in order to go about their daily lives. And for now, capitalism still remains the best mechanism to facilitate the exchange of those goods and services. I've got to say that when I read that, this is probably something that only came across into my consciousness probably 2 or 3 years ago. And the value creation that comes from owning businesses as opposed to almost anything else. If capitalism is in place, then it almost seems certain that businesses will be the source of most wealth creation. Broadly, would you agree with that?
Oh, definitely.
Yeah. And so do you let the macroeconomy or the economy in general inform your view, or is it strictly bottom up in your appraisal of companies?
Yeah, it's strictly bottom up. But I guess the top down creates opportunities, right? So it's when the macro changes, the stock prices change. But if you can maintain a strict adherence to bottom up amidst volatility or panic, you'll do well. Yeah.
Mm. There are just a couple of other quotes that I pulled out of your letters over the years. In 2013, this is when your fund, from my memory, made about 50% in 1 year. You were talking about central banks in 2013 taking the action to raise debt ceilings, all that sort of stuff. And you're saying undoubtedly the extreme actions which have been undertaken by the major central banks around the world have influenced the financial markets and in turn the trust results, although by how much I could not say. And this is the important bit you say. The only tool I have at my disposal to understand the reasonableness of any price movement is by referencing that price to the underlying worth of a business. I am comfortable with where the trust businesses are being priced at this point in time. I am aware that during the half-year communication, I expressed concern at the degree to which the prices had moved, and I may appear to be contradicting myself. And this is the question that I have for you. You say, I am also acutely cognizant of the trap of talking yourself into the game. That is, when you can no longer justify the prices being paid, of simply sitting out. You change your assumptions and shift the goalposts so that things look cheap again, and viola, you're back in the game. This highlights to me one of the silent killers in finance, one's own self. How do you not fool yourself into, I guess, that what I might call thesis creep? Or what are some of the mental reminders, if you like, that you need to play on yourself to avoid that type of thinking?
Yeah. I think not like, I don't want to sound like a broken record, but having a benchmark that helps you keep space from having a relative mindset is important. So again, if you're getting measured off a subset of the index, then typically the index on average is taking a multiple over the basket of stocks. If by virtue of central bank policies or government actions, interest rates are dropping and that multiple is getting higher, then it's going to be harder for you to not kind of tweak things in your own assumptions to just make something cheaper. If you're prepared to just pay a higher multiple, or you'll accept a lower rate of return, they're two sides of the same coin. That's harder for you to do if you've got an index that you're getting measured against. And that's what forces people out to kind of play in some way. And then kind of outside of that, it's tough. Like it's a good question. And I think I should probably read some of my earlier letters again. But you know, it's comes back to how clear and disciplined the actual investor is, how much they can reflect on their own behaviors. Like in the end, if you're the one, like you have to be your own, you know, kind of watchdog policeman to say, yeah, you know, I think they can do a bit better now. You know, I'm going to bump up what I think their revenue is going to be. I'm going to reduce what rate of return I need, or otherwise increase the multiple. You have to be the one that understands what you're doing. You're increasing the risk that you're exposing your investors to, because you're assuming the company is going to otherwise do better than what you previously thought. And you know what? That might be legitimate. You might have done more research that suggests this company has a bigger opportunity than you previously thought. And that could be a very justifiable, accurate thing for you to do. But likewise, that might not. You might be just changing things to keep up with what the stock price is doing, which is, you know, can be quite likely over a period of time very bad. So I think it kind of comes back to the discipline of the investor. Can they reflect on their own actions? Have they learnt to reflect on their own actions to see what dysfunction might creep into their thinking to keep them in the game? And it's hard. Like, you know, I think investing is an incredibly individual pursuit, as much as it doesn't seem like it. Like everyone needs, like, you know, you go to talk to a big institution and it's like, where's your investment committee? And show me all of these people that, you know, help inform the investment decisions. And it's like, you know what, like when it comes down to it, someone's got to make a decision, and someone's got to own that decision, and someone's got to, you know, reflect on why they're making that decision. And when you get some disconnect between all of those things, who's making the decision, the consequences to that person for the decision, then you get poor outcomes. And, you know, what might be right for me, this is now kind of even between two individual investors, what might be right for me might not be great for you. You might be seeking a return that's different from mine, over a horizon that's different from mine. So we could look at the same company and we could have the exact same perspective on what this company will do in the future. You know, it's here, it's like it's at this point today, and I'll try to do it in this way. We think it's going to be, we both have the exact same idea of where we think it's going to be in the future. Which implicitly, you know, let's assume we got kind of the same idea of future multiples, all that type of thing. Like I could look at that and say, you know, I'm going to invest in that, and you could look at that and say, you know, I'm not going to invest in that, because that just doesn't yield the profile that I'm trying to generate for my investors. So even two known factors or two known variables can still yield two different people, two different decisions. So, and then that's not to introduce all of the kind of subjectivity and uncertainty of the real world, like, you know. So I think investing is just to try to wrap that up for you, investing is really an individualistic pursuit, and it comes down to the individual to understand, are they being honest with themselves when they make this investment decision? Is it genuinely the opportunity that they think it is, based off their absolute objectives for their own investors.
I've never seen a good investment team make decisions by committee.
Yeah.
I've never seen that. One last question then, Luke. Everyone says that they are, an independent thinker and what have you. And, to an extent, we do have to leverage insights from others to improve ourselves and to learn the ropes, so to speak. What do you spend most of your time reading, listening to, and watching and just consuming? What type of information do you spend more of your time thinking about? Is it, not necessarily in your 9 to 5, so to speak, but outside of work hours?
Yeah.
What intrigues you?
People intrigue me. People fascinate me. Just the way people live, the way they shape their lives, what's important to them, what gets a reaction from them, why do they react that way? A lot of people seem to be in they live in a way that is reactive. They just keep the way the world works, right? We're just bombarded every single day with stimulus and challenges, and there's not too much in the world that is put there to make your day better or to make your life easier. And that's the whole, kind of bit philosophical, but we're not put on the planet to have a good time. It's no one's birthright to have a good time, just like it's no one's birthright to be poorly treated. But we're all here, and we all live in this world that constantly challenges us every single day. That's the way the world works. That's the idea of competition. That's the way kind of new things come through. If it wasn't, then we wouldn't get this kind of continual improvement and advancement in society, economies, everything. But it's daunting and it's kind of overwhelming, and people respond to that in different ways. And I guess if you're trying to look and invest in companies that serve people, then you need to kind of understand how people respond and the way people will react, and probably more fundamentally to understand yourself, the way that you respond and you react to different things. And that helps me. I feel like I'm try to be a better, I've got 3 young girls. I've got a wife, and I try to do everything that I can for them with, the limitations that I've got. And it's professionally a kind of a similar approach. With the tools that I've got, I try to deliver the investors the best outcome that they've got. But yeah, to kind of achieve those 2 things, to be a good husband, father, and investor, I think you need to kind of reflect on yourself and kind of why you do things or why you don't do things, what interests you, what doesn't interest you, and kind of all those types of things. And then it kind of naturally, for me, it kind of makes me look out and try to understand why people do things and why they don't do things. So I like to read books that help inform that, just help open my perspective up, to understand the world, how the world works, why the world works. Like to look up and go, well, it's not just about going to the office Monday to Friday, 9 to 5. It's like, well, we're doing this for a reason. And why are we doing this? And what's the bigger thing here? You don't want to kind of just get to the end of your life and be like, oh, well, that was fun. I kind of worked for 40 years and for what? So try to really reflect on those types of questions to make sure that I'm doing things that I really believe in, and we're investing in companies that I feel like are going to, add positively, contribute to society in some way, shape, or form. Yeah, of course, you'd imagine, I would hope at the end of the day that you can look back and go, I added some value to the world. It might be, as in anything, any way that value may accrue, and we all have different ways that we can do that. Some people might be artistic, which is just so cool. It's something that I'm artistically challenged. I couldn't strum a guitar to save my life, but some people can do that, and that's just, I think, it's so inspiring. Some people can sing, some people can write books, some people can just sit with another person and make them feel better. It's really nice to see different ways that people contribute to the world, and if I can kind of also contribute in some way, then I'd be really, really happy.
Is there any one that you draw inspiration from?
Well, I mean, I've read books by Eckhart Tolle, or Eckhart Tolle, sorry, and I find his work to be quite profound. I feel like he kind of cuts through a lot, which is, and delivers at the core of it, a really clear perspective on life. Like I love reading any books that I'm reading a book at the moment called My Stroke of Insight, which is about a lady who has a massive stroke over the left part of her brain, and it kind of just wipes all analytical ability for her to, like, analytical reasoning, and she's just kind of this being floating in the world, just kind of absorbing, interpreting the world purely from her right brain, which is just so incredible to understand someone's perspective, how it can change so dramatically when the kind of circuitry in us changes. There's actually nothing different to the world, but the way that she's perceiving the world, which I find really fascinating. Then, other things, like in terms of the functioning of how things work. Brian Cox is a physicist who just delivers these beautifully digestible forms of kind of entertainment and information about how the world is put together and how it works, and it's just really, really fascinating. So I think we're kind of, it's exciting. You never really know, and daunting, kind of what's going to happen each day, just generally, and then let alone when you wake up in the morning and have a look at what the US might have done overnight. So there's kind of, the world is constantly in motion, and just kind of sitting back and reflecting on that motion is really exciting to watch.
Yeah. You mentioned a lot of names there that are people that I have a lot of time for when I'm thinking.
Yeah.
There's one thing that I often do is I often look up at the stars at night, and I think, if I'm here being an investor, and my role is, the galaxy is the universe is so many billions of years old, and here I am with this speck on the speck of dust for a little bit of time. What do I want to stand for when I look back over the next 50 or 100 years? And if my little patch of dirt sees me invest better and help other people invest better, then that's what's important to me. Yeah. And I use that as both an exercise to remind me to do better, but also to remind me that what we're doing is important, and when we're given the opportunity to do better, we do it. Mate, I'm just conscious of time, so I might wrap it up just then. Maybe just one more point that I tend to ask everyone. I didn't have it on my list of questions to try to put to you. Is just if you could go back in time and give your younger self a piece of advice, what would it be? It can be investing advice, can be anything.
Probably say just relax. Just enjoy the ride. It's interesting. It's kind of life investing is this kind of outward and inward kind of pursuit, I think. Well, that's the way I live it. A lot of the way that we live and the way that we're taught is like constantly pushing out, trying to do stuff, achieve stuff. And we're not often taught how to just slow down, stop, step out, and reflect, like what you were just saying. And I learnt kind of the hard way through challenges and being basically having life shake you and go, something's not working, you make errors or whatever it might be, you're unhappy. And, it wasn't until kind of, life kind of really shook me that I was like, started to really kind of reflect back and, kind of when you reflect back in, then you start to actually look out in a different way. And so, yeah, if I could say something to my younger self, it would be kind of just to relax and enjoy the ride and not kind of get too caught up in trying to do stuff and push things out all the time.
It's great advice, mate.
Some advice.
I like it.
Thank you.
Luke, thanks for taking the time to join me on the show, mate.
No problem. I really appreciate the chance to chat, Owen, and happy to contribute in any way, shape or form.
I hope we can do it again sometime.
Definitely.